Something big just happened at the Fed that's going to explode stock prices higher. And in this video, I'm going to explain what they're doing, how much bigger this is than anything they've done before, and what we can expect moving forward. Now, you don't want to miss what the markets are going to do next, so stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about markets. I like to talk about making money. I like to talk about investing money. I like to talk about just having overall success in life. If you like those topics, stick around on the channel. Make sure to click the like button and the subscribe button so you're notified whenever I put new videos out. All right, now we are talking about what's going on in the markets. They're about to blow up, but which way? Blow up, blow down? What's going on? Now, it's obviously no mystery at this point that the markets are completely disconnected from the real economy. At the same time, we're seeing the economy go down, down, down. We're in some sort of a recovery. It's some sort of a letter. I don't know what letter it is anymore. U, V, W, whatever, right? But the economy's going down. Businesses are out, employment's up, but the markets are still going back up. And the reason why, no surprise, I've done a lot of videos on this, that the Feds, they came out. The Feds came out with guns blazing, ready to do anything, pulling out the money bazookas, the money cannons, and trying to get the market going back up. And I think part of the reason why they moved so fast and so hard is because they're trying to learn from their lessons of 2008. In past depressions and past recessions, we've seen them come a little bit too slow, a little bit too late, and it didn't get the desired effects that they want. I think they also knew that this was more severe than anything they'd ever seen before. And so they just unleashed a whole series of programs, a bunch of 3-4 letter programs. I've talked about all those different ones, and basically just started buying everything up. They're the buyer of last resort. They're like, if no one else is going to buy the financial assets, I guess we'll buy them, right? Just like nobody wanted to loan the U.S. government money for the last several years, so the Fed prints the money and loans the money, right? And so they're basically doing the same thing. Now we saw Fed Chair Jerome Powell. He came out and he used big words, and he told us he was going to do whatever was necessary. He said they were prepared to do QE to infinity. How big is infinity? Shoot, it's infinity. He used the word unlimited. So they told us from the beginning they were going to do anything that it took, and they're pretty much there. They have about one more tool in their arsenal, and I'm going to explain what that is at the end. All right, now we see, like I said, the markets dropped and they've rebounded really fast after the whole QE, unlimited, and infinity, and all that talk. Of course, the market rallied, right? Wouldn't you expect it? They're up about 47% off the bottom, which is huge. Now, after a rally that goes that long, you need a break, right? I like to think of it like if I'm walking, I can walk really far, and I can, if I walk slow. If I'm running, I can go faster, but I can't go as far. And if I go for a full out sprint as fast as I can, I'm probably only going to go 100 or 200 yards and have to stop and take a break. And the markets are about the same way. And so after a rally, they need a break. And when they do a 47% rally, then for sure they need a break, right? The faster they go, the more they need a break. And what happens, they go into this break, or what's kind of known as a consolidation pattern, kind of back up a little bit and kind of stick within a range of consolidation pattern. And those consolidations give them energy to go for another run, kind of like you stopping to catch your breath. Now, the problem that we have right now is that the markets seem like they're addicted to growth, meaning they have to go up almost like a shark, right? Always have to be moving or they're going to die. And so the markets have to be growing, growing, growing. And I'm talking about growing at all costs, sacrificing all the future for today. And so we know this as a fact because we can see it. The markets, after a 47% bounce back, had about a 9% correction. So while a 9% correction is big, I get it. A 9% correction after a 47% run up in like a month isn't that big. But the Fed could not stomach that. They couldn't allow that 9% drop to happen. And so basically at the last Fed meeting, was just a week or so ago, they said a bunch of different things that gave us some really good insights into what they're doing. They talked about how the financial sector has vulnerabilities that are expected to be very significant in the near term. And so they understand there's a lot of problems and they're expected to be significant, they said, in the near term. So they're getting this ready for something. They said that a sharp reduction in tax revenues is placing significant stress on state governments. Yeah, of course, right? So the state shut everything down. There's no businesses. If no businesses are operating, there's no tax revenues. With no tax revenues, how do the cities, the counties, the states pay for things? They don't. Massive stress on state governments. They said that long-term repercussions would be that small businesses and firms would shut down, declare bankruptcy, causing permanent problems. Yeah, of course, if these businesses go out of business, there's no tax revenue ever going to come from that. There's no jobs, there's no tax revenues coming. Big problem. They said that despite aggressive fiscal and monetary policy actions, that risks abound all over the place and they're skewed to the downside, meaning no matter how aggressive they seem to be, the risks are still there and it's trying to drag the market down. And then finally, the point that they made was that the economic damage of the recession may be quite persistent, meaning that it's going to stick around for a long time and they're going to have to continue to throw stuff at it. But like I said, I'm going to show you that what they've done today only leaves them one more tool in their arsenal, at least as far as I can see right now. Who knows what other magic tricks they'll come up with, but I'm going to explain what that is at the end. And so basically what they're saying is they're not going to wait. They're not going to wait around for things to get worse because they see lots of problems in the short term and so they need to act. And so basically what they decide to do, well, almost the last tool in the shed, but they finally announced that they are going to start buying corporate bonds. And when they're buying corporate bonds, they are coming in hot. Now, the first Fed purchases were back in March 23rd, not that long ago. And basically, after they started doing that, investors jumped in and they pushed the market higher. They started rallying. So the investors are like, well, shoot, if the Fed's going to buy everything, they're not going to let it drop. So I'm going to jump in front of them and let them push me up, which has worked out pretty good. Like I said, a 47% return, but that was nothing. The central bank has taken in roughly $5.5 billion through its ETF purchases so far, and its primary market corporate credit facility, which will focus on buying the debt directly from the firms, isn't even operational yet, and they're prepared to take on $500 billion of corporate credit. So we've seen $5.5 billion, they're prepared to go to $500 billion. We're talking about a big difference from 5 to 500. So if you're not sure what this means, let me explain. So first, if you don't know, bonds are debt. All right. So when a company, a corporation wants to take a loan, borrow money, they issue a bond. All right. And when I buy that bond, I'm basically loaning money to the company, right? It's kind of like if you're running your household and you go broke, you lose your job, maybe because of the pandemic, you don't have a job, you can't pay your bills. What do? Well, you can live off of credit cards, right? And if you go completely broke, you can live off the borrowing, live off the credit cards, as long as people are willing to loan you money. Now, at some point, they're not going to loan you money anymore because you don't have a job, right? And so that's exactly what the corporations are doing. There's no revenue coming in, but people are loaning them money. Now, like I said, as long as people are willing to loan them money, but when we loan money, we expect to get that money back. We expect to get that money back with a return. We want profit, right? But the Fed, they don't care. They don't care about profits. And so the Fed can just pile in money to prop these companies up without any care about profit. Now, the Fed already started buying bonds. So you might be going, wait a minute, they already buying bonds, and they are. But this is a big difference. So they were buying bonds in bundles, meaning they were buying bonds, debt through ETFs and indexes. So they're buying broad market indexes, all right? And they're going to continue to do that. But now the difference is, besides going from 5 to 500 billion, the big difference is instead of going very broad and buying indexes, now they're going to be able to buy individual companies, which will make it very strategic. I mean, they're basically going to be picking winners and losers. They're going to buy individual companies. You win, you lose. Sorry. That's what they're going to do. And now they can basically prop up any company they want. So again, back to your own analogy, if you're out of work, you're out of money. As long as people keep loaning you money, you can keep paying your bills. And so they can basically keep propping up these companies as long as they want. They don't have to turn a profit. They can just keep borrowing money from them, right? And so instead of letting companies fail, they'll just continue to have these zombie companies. Now, this is almost the last tool that the Fed has. Like I said, I think there's one more, which I'm going to explain. But first, let's just recap real quickly. What are they already doing? What other tools have they already pulled out of the shed? Well, let's take a look at that. So the Fed is already buying the treasury markets. So this is like the U.S. sovereign debt, right? Like I said, nobody wants to loan the U.S. money anymore. So the Fed does. What the heck? The Fed prints it out of thin air, loans it to the government. No big deal. All right. They've already been buying municipal bond markets. Now, this is debt issued by states and cities. Remember where I said that with no tax receipts, then the cities, the states, the counties have no revenue. And so again, they need debt. They need to borrow money. And so the Fed's already buying that. The Fed's already buying corporate bond markets, like I said, through index funds, ETFs, et cetera. So that's broad indexes of the market. And now they're buying individual corporate bonds, all right? They're already buying commercial paper markets. This is like short-term corporate debt. And they're buying asset-backed security markets. This is everything from like student loans, certificate of deposits, and things like that. I mean, they're basically buying every type of financial assets that's out there. And of course, the question is why? Well, I guess why isn't that big of a question? We know they're terrified of the market starting to spiral out of control. As I reiterated the points from their last meeting, they've identified all the problems and they can't allow this to get away from them. And so they're trying to stay in front of it. And Chairman Powell said at the meeting that the Fed is, quote, years away from halting its asset monetization scheme, end quote. They're years away. They're prepared to go at this for a long time. Now, as I've said over and over, the Fed's terrified to a point that it can't even allow a 9% drop, even after a 47% gain. Now, it's only a matter of time before the Fed starts buying stocks directly. Now, that's the last tool that I see in the shed, at least for now. I'm sure they'll come up with some more financial wizardry at this point, but basically the next step is they're buying stocks, all right? Now, I'm guessing based off of their reaction, what they're saying, and the fact that they can't stomach a drop, that the very next dip that we see, they're gonna go ahead and go all in. They'll start buying stocks. Now, I think that's gonna be sometime in the next 6 months, all right? So I think sometime around the presidential election cycle, we're gonna see another dip, and that's when the Fed's gonna freak out and they're gonna try and start buying stocks. So make your list, all right? Make your list. What stocks do you want to buy when the market drops? Because the market's going to drop, we're going to have an entry to get in, and then the Fed's going to come out buying stocks, full guns blazing, and pump this market even higher. That's what it looks like right now. So make your list. What are the companies you would want to buy if the market dropped another 30, 40%? You missed your chance to buy at 47% off, but you're going to get another chance. So are you ready? Make a list of the companies you want to buy. Make a list of the prices that you want to buy them at, your entries, right? And then just buckle up, right? Just buckle up because it's going to get crazy. It's going to be a blow off top. I believe the blow off top in the market cycle is still ahead because the Fed's going to do what the Fed's going to do. They're going to basically keep the pedal to the metal until it blows. That's all they can do. Now, if you missed my live presentation I did just last week, I talked about world dominators. And world dominators are the best companies in the world. They dominate basically the world. And there's a few certain characteristics of these world dominators. One of the big things is that they continue to gush cash flow year after year after year. They're so dominant that nobody can even challenge them. And so I showed you everything, how to identify the companies, how to find the companies, and most importantly, how to identify what the risk-free price is, meaning the price is so low that you can basically enter for no risk. Now, we're about to have another market drop. At least that's what it looks like right now. And so if you've made your list of these companies, you're going to have a chance to buy them. Now, if you missed my live presentation, that's okay. You can catch the replay. I'm putting a link down below. You can just watch the replay at your own leisure. And hopefully that makes sense to you. Hopefully you can learn how to identify these companies, make your list, because I believe the chance is coming. And then the Fed's gonna pump this thing until it blows. So buckle up, all right? Hopefully you like that. If you like this video, give me some thumbs up on the video. If you don't like the video, then I don't know what's wrong with you. No, I'm just kidding. Give me a thumbs down. Either way, let me know what you think and leave me a comment down below. Do you think we're gonna have another dip in the next 6 months, or are we going straight up until they blow? Let me know one way or another. I'd love to have a conversation with each one of you in the comments down below. And that's all I got for right now. To your success, I'm out.